What if I told you that the Federal Reserve is sitting on a $390 billion silver exposure that could shake the entire financial system to its core? And they're doing everything in their power to keep you from finding out about it. Stay with me, because what I'm about to reveal will change the way you see the global economy forever. This is the Gray Ledger, and today we're diving deep into one of the most carefully guarded secrets in modern finance. Before we go any further, if you want to stay ahead of the financial curve and understand what's really happening behind closed doors, hit that like button right now and subscribe to the channel. Trust me, you'll want to be part of this community when things start to unravel. Now, let's get into this. The story begins not with silver itself, but with a decision made decades ago that seemed harmless at the time. Back in the 1970s, when the United States officially abandoned the gold standard, something interesting happened in the precious metals market. Gold got all the attention, all the headlines, all the panic. But silver quietly became something else entirely. It became industrial. It became essential. And most importantly, it became scarce in ways that most people still don't understand today. You see, silver isn't just a shiny metal that people collect or invest in. It's in your phone right now. It's in the solar panels that governments are desperately trying to install to meet climate goals. It's in every electric vehicle battery, in medical equipment, in water purification systems, and in military technology. Unlike gold, which mostly just sits in vaults looking pretty, silver gets used up and it doesn't come back. When you use silver in industrial applications, it's gone, dispersed in tiny amounts across millions of products, essentially unrecoverable. Now here's where things get interesting, and this is where the Federal Reserve enters our story. Over the past several decades, as silver demand has exploded due to technological advancement, something strange has been happening in the derivatives market. The derivatives market, for those who aren't familiar, is essentially a casino where big institutions place bets on the future price of assets. But unlike a casino, when things go wrong in the derivatives market, it doesn't just hurt the gamblers. It can collapse entire economies. The Federal Reserve, along with several major banks, has been involved in silver derivatives for years. These are complex financial instruments that are supposed to hedge risk or provide liquidity to the market. That's the official story anyway. But when you look at the actual numbers, when you peel back the layers of financial engineering and accounting tricks, you start to see something very different. You start to see exposure. Massive, unprecedented exposure. According to leaked documents and financial reports that most people never bother to read, the Federal Reserve's exposure to silver through various mechanisms now exceeds $390 billion. Let me put that number in perspective for you. That's more than the GDP of entire countries. That's enough money to buy every ounce of silver mined globally for the next several years. And here's the kicker. Much of this exposure is tied to derivative contracts that assume silver prices will remain stable or decrease. But what happens when reality doesn't cooperate? What happens when supply can't keep up with demand? What happens when industrial users start panicking because they literally cannot get the silver they need to manufacture products? The Federal Reserve has a problem, and that problem is getting bigger every single day. Think about it this way. Imagine you borrowed your neighbor's lawnmower and promised to return it next week. But then you lent that lawnmower to 10 other people, and they each lent it to 10 more people. Now, hundreds of people think they have access to that one lawnmower, and they've all made plans that depend on it. What happens when everyone shows up to claim it at the same time? That's essentially what's happening in the silver market right now, except instead of a lawnmower, we're talking about a critical industrial commodity. And instead of disappointed neighbors, we're talking about entire industries grinding to a halt. The Fed knows this. The major banks know this, but they're trapped in a system of their own making, and they can't simply unwind these positions without causing the very crisis they're trying to avoid. So they do what powerful institutions always do when they're caught in an impossible situation. They hide it, they downplay it. They use complex language and bury the real numbers in footnotes of reports that they know most people will never read. But here's what they can't hide. The physical silver market is tightening. Premiums, the amount you pay above the spot price to actually get your hands on physical silver, have been rising steadily. Delivery delays are becoming more common. Industrial users are starting to get nervous, and some are even stockpiling silver just to ensure they have enough to keep their production lines running. Meanwhile, global silver mine production has been relatively flat for years, and in some regions it's actually declining. We're not discovering massive new silver deposits the way we used to. The easy silver has already been pulled out of the ground. What's left requires more energy, more resources, and more money to extract, which means higher production costs. And here's something most people don't realize about silver mining. Roughly 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. So silver production is largely dependent on the economics of these other metals, not on silver demand itself. You could have skyrocketing silver demand, but if copper prices are low and copper mines are shutting down, guess what happens to silver supply? It contracts even further. This creates a supply crisis that no amount of financial engineering can solve. You can't print silver. You can't create it out of thin air with a few keystrokes like you can with currency. It has to be physically mined, refined, and delivered, and that takes time, energy, and resources that are becoming increasingly scarce. Now, let's talk about what the Federal Reserve has been doing behind the scenes. Through various programs and facilities, the Fed has been essentially backstopping the bullion banks, the big players who trade precious metals. These banks have enormous short positions in silver, meaning they've bet heavily that silver prices will fall or remain low. When you short something, you're borrowing it and selling it with the promise to buy it back later at a lower price. It's a profitable strategy when prices are falling, but it's catastrophic when prices rise, because your losses are theoretically unlimited. Now imagine you've shorted billions of dollars worth of silver, and suddenly the price starts climbing because physical demand is overwhelming available supply. You're obligated to buy back that silver to close your position, but the silver doesn't exist in the quantities you need. Or if it does exist, acquiring it would push prices even higher, making your losses even worse. This is called a short squeeze, and it's one of the most dangerous situations in financial markets. The Federal Reserve, through its relationship with these bullion banks, has become entangled in this mess. When these banks face liquidity problems because their silver positions are going against them, who do you think steps in to provide emergency funding? That's right, the Fed. And every time they do this, they're essentially taking on more exposure to the silver market without most people even realizing it's happening. This isn't conspiracy theory, by the way. This is visible in the Fed's own balance sheet and in the quarterly reports filed by major banks if you know where to look and how to read between the lines. The Office of the Comptroller of the Currency publishes reports on bank derivatives exposure. The numbers are staggering. We're talking about trillions of dollars in total derivatives exposure across the banking system, and precious metals derivatives, including silver, represent a significant and growing portion of that. But here's where it gets even more concerning. The concentration of this risk is in the hands of just a few banks. We're not talking about risk spread across hundreds of institutions. We're talking about maybe 4 or 5 major players holding the vast majority of these positions. That means the failure of just one of these institutions could trigger a domino effect throughout the entire system. And because the Federal Reserve has positioned itself as the lender of last resort, guess who would be on the hook when things fall apart? That's right, ultimately the American taxpayer. You might be wondering why this hasn't blown up already. Why hasn't this become a major crisis if the situation is so dire? The answer is simple: control. The Federal Reserve and the major banks have been able to maintain control over the silver price through the paper market. For every ounce of physical silver that exists, there are hundreds of ounces of paper silver, derivative contracts and certificates that represent silver but aren't actually backed by physical metal. As long as most people are willing to trade these paper claims instead of demanding physical delivery, the system holds together. It's like a game of musical chairs where everyone assumes there will be a seat available when the music stops. But what happens when people start demanding physical metal? What happens when industrial users say, we don't want a contract, we don't want a certificate, we need actual silver delivered to our facility right now? That's when the music stops. And that's when we discover there aren't nearly enough chairs for everyone. We've already seen glimpses of this. In 2020 and 2021, there were significant delays in physical silver delivery. Premiums spiked to levels never seen before. Retail investors were paying 30 to 40% above spot price just to get their hands on coins and bars. The U.S. Mint had to ration Silver Eagle production. Dealers were running out of inventory. And here's the important part. That was just from retail demand. That was just regular people buying silver for investment or collection purposes. Imagine what happens when industrial demand intensifies as well, when solar panel manufacturers and EV battery makers and electronics companies are all competing for the same limited physical supply. Now, some people will tell you that high prices will simply bring more supply to the market. That's basic economics, right? Like when prices rise, producers produce more. But as I mentioned earlier, silver production doesn't work that way because most of it is a byproduct. You can't just decide to mine more silver if it means mining copper or zinc becomes unprofitable. And even if you could, it takes years to bring new mines online. You can't just flip a switch and increase global silver production by 20 or 30%. The infrastructure doesn't exist. The investment hasn't been made. Because for years, the suppressed silver price hasn't justified that kind of investment. So we have this perfect storm brewing where demand is accelerating, supply is constrained, and the financial system has built a massive house of cards on top of the assumption that everything will remain stable. The Federal Reserve is sitting right in the middle of this storm, and they know exactly what's coming. They've run the scenarios, they've done the stress tests. They understand that if confidence in the paper silver market breaks down, there's no easy way out. Now, you might be asking yourself, why would the Fed allow this to happen in the first place? Why would they let these banks build up such massive exposure to a single commodity? The answer lies in understanding the relationship between precious metals and confidence in fiat currency. When people lose faith in paper money, they historically turn to precious metals. Gold and silver have been money for thousands of years. That instinct doesn't just disappear because governments declare pieces of paper to be legal tender. By keeping precious metals prices suppressed, especially silver, which is more accessible to average people than gold, the Fed helps maintain confidence in the dollar. If silver were trading at its true supply and demand price, it might be 2 or 3 or even 5 times higher than it is today. And what message would that send to the public about the value of their dollars? It would suggest that inflation is far worse than official numbers indicate. It would suggest that the purchasing power of currency is eroding faster than people realize. It would trigger exactly the kind of loss of confidence that central banks fear most. So the suppression of silver prices isn't just about protecting banks from losses on their derivative positions. It's about protecting the entire fiat currency system from a crisis of confidence. But here's the fundamental problem with any suppression scheme. It can only work for so long. Eventually, physical reality asserts itself. You can manipulate prices on paper. You can create synthetic supply through derivatives. You can use accounting tricks to hide the true nature of your exposure. But you cannot create physical silver out of thin air. And when industrial users need physical metal to keep factories running and products shipping, paper promises become worthless. We're approaching that moment of truth, and the Federal Reserve knows it. So, what are they doing about it? Publicly, nothing. There's no acknowledgement of a problem, no discussion of silver markets in Fed minutes or press conferences, no warning to the public that a crisis might be brewing. But privately, there are signs of panic. Why else would the Fed be maintaining such extraordinary accommodative policies even as inflation runs hot? Why else would they be so reluctant to truly tighten financial conditions despite rising prices? Because they know that the moment they remove the training wheels, the moment they stop providing unlimited liquidity to the financial system, these over-leveraged positions start to unwind. And when they unwind, the losses could be catastrophic, not just for the banks holding these positions, but for the entire financial system that's interconnected with them. Let's talk about what happens when this finally breaks, because it will break. It's not a question of if, it's a question of when. When the physical silver market finally decouples from the paper market, when people demand delivery and discover that the metal isn't there, several things will happen very quickly. First, silver prices will spike dramatically. We're not talking about a 10 or 20% move. We're talking about the kind of vertical price action that breaks trading systems and triggers circuit breakers. Second, industrial users will panic, and they'll start hoarding whatever silver they can get their hands on, which will accelerate the shortage and push prices even higher. Third, the banks with large short positions will face massive margin calls. They'll be forced to either come up with enormous amounts of capital to maintain their positions, or close those positions by buying silver at astronomical prices. Either way, the losses will be staggering. And fourth, the Federal Reserve will face a choice. Do they let these banks fail and risk a systemic financial crisis? Or do they bail them out, effectively monetizing these losses and further destroying the value of the dollar? Neither option is good, and both have serious consequences for average Americans. If they let the banks fail, credit markets could freeze up just like they did in 2008, maybe worse this time. If they bail them out, inflation could spiral completely out of control as they print trillions more dollars to cover the losses. This is why they're hiding it. This is why you don't see this discussed on mainstream financial news. This is why the official narrative is always that everything is fine, markets are functioning normally, there's nothing to worry about. Because the moment people understand what's really happening, the moment this information becomes widespread, it could trigger the very crisis they're trying to prevent. People would rush to convert their paper assets into physical metals. Industrial users would accelerate their stockpiling, the short squeeze would intensify, and the whole system would come crashing down faster than anyone could contain it. Now, before you think this sounds too dramatic or too far-fetched, remember that we've seen similar dynamics play out before in other markets. Think about the mortgage crisis of 2008. Everyone in power knew there were problems in the housing market. The warning signs were everywhere. But the official message was always that things were contained, that the fundamentals were sound, that there was no reason for concern, right up until the moment it all collapsed. Or think about the long-term capital management crisis in the late 90s. A single hedge fund with massive derivatives exposure nearly brought down the entire global financial system. The Fed had to organize a bailout to prevent systemic collapse, and that was just one fund. Now we're talking about exposure that's spread across multiple major banks and involves the Federal Reserve itself. The scale is so much larger. The potential consequences are so much more severe. And the ability to contain it is so much more limited because the Fed is already part of the problem. So what can you do with this information? First, understand that knowledge is power, and the fact that you're watching this video means you're already ahead of most people. Second, consider how this affects your own financial situation and preparedness. Third, share this information with others who need to know. Leave a comment below with your thoughts on this situation. Do you think the Fed can continue to keep this hidden, or are we approaching a breaking point? Share this video with people who need to understand what's really happening in the financial system. The more people who are aware, the harder it becomes to maintain the illusion. Now, let's talk about the timeline, because that's what everyone wants to know. When does this actually blow up? The honest answer is that nobody knows for certain. These kinds of crises are notoriously difficult to predict in terms of exact timing. What we can say is that the pressure is building every single day. Every day that physical demand exceeds new supply, the deficit grows. Every day that industrial users consume silver that cannot be recovered, the available supply shrinks. Every day that the derivatives market becomes more disconnected from physical reality, the eventual correction becomes more violent. There are some potential catalysts that could accelerate this timeline. A major bank failure could expose the true extent of derivatives exposure. A significant industrial shortage could cause prices to spike suddenly. A geopolitical event that disrupts silver mining could constrain supply overnight. Or simply, a loss of confidence in the dollar could drive people toward hard assets. Any of these catalysts could be the spark that ignites this powder keg. The Federal Reserve is not preparing the public for this possibility. There's no discussion of precious metals in their financial stability reports. There's no acknowledgement that derivatives exposure to commodities could pose systemic risk. That silence is telling. It suggests they understand the risk very well and have decided that public awareness would make things worse. They know these over-leveraged positions exist. They know physical supply is tightening. They know the derivatives market is built on assumptions that may not hold. And they've calculated that maintaining public confidence for as long as possible is their best strategy. This is classic central bank behavior throughout history. Central banks have always prioritized stability and confidence over transparency and truth. They operate on the principle that managing public perception is just as important as managing actual economic conditions. Because in a fiat currency system, confidence is everything. The moment people stop believing in the value of paper money, it collapses. So the Fed plays a constant game of managing expectations and controlling narratives. But silver is different from other markets they've tried to control. Unlike interest rates or currency values, silver is a physical commodity with real supply and demand dynamics. You can set interest rates by decree, you can print currency at will, but you cannot create silver through monetary policy. And that's what makes this situation so dangerous for them. They're trying to control a market where the fundamentals are ultimately beyond their control. They cannot change the fact that industrial demand is growing while supply is constrained. They cannot change the fact that every year more silver is consumed than is mined. They cannot change the fact that above-ground inventories are declining. And they cannot change the fact that their $390 billion exposure becomes more problematic with each passing day. So here we are, watching this slow-motion crisis unfold while most of the world remains completely unaware. The data is hiding in plain sight for anyone willing to look. The logic is inescapable once you understand the basic dynamics. And yet, the mainstream narrative continues to be that everything is fine. This is the gray ledger, and our job is to look beyond the official narratives. This silver situation is one of the most important financial stories that nobody's talking about. And when it finally does break into public awareness, remember that you heard about it here first. Now, I want to be clear about something. I'm not telling you to panic or make rash financial decisions. What I am telling you is to be aware, to understand that the financial system is more fragile than it appears, to recognize that the people in charge don't always have your best interests at heart, to think critically about the information you're given. The Federal Reserve's silver exposure is real, it's massive, and it's growing. The physical shortage is real and accelerating. The disconnect between paper and physical markets is widening. And the potential for a serious crisis is increasing with each passing day. We're heading toward a reckoning in the silver market. And when it comes, the consequences will ripple through the entire financial system. The Fed knows this, the big banks know this, and now you know this too. So stay informed, stay aware, and stay ahead of the curve. And make sure you're subscribed to the Gray Ledger because we'll continue to follow this story. We'll track the data and watch for the warning signs. The $390 billion question is not whether this crisis will happen, but whether you'll be prepared when it does. Thanks for watching, and I'll see you in the next one.